Good morning, it's Jeffrey Christian from CPM Group. We will be releasing our Silver Yearbook for 2022 today, and this briefing focuses on that report and its findings. I am joined with my colleague, Rohit Savant, who's the primary author of the report, and he will talk about investment demand, fabrication demand, total supply, and other aspects of the market after I've run through some initial highlights and talked a little bit about the price. And Carlos Sanchez, another business partner and colleague of mine for many decades now, will be handling the question and answer period. Got a lot of ground to cover, so we'll just jump right in. First, I want to thank the sponsors and partners that we have. We have 21 sponsors this year. That's up from 12 last year. The power of price moves and investment demand, there's an ebb and flow of the number of sponsors we have. I think we peaked in 2011 when the silver price peaked at 25 sponsors. And some of those companies, several of those companies have been absorbed into other companies in the ensuing years. And during the bear market, some of others walked away. Some of the companies have come back, and we're really happy to have them. With 21 companies, I'm not going to name everyone, but I will say, Fortuna Silver Mines, which was a sponsor for many years, is back, and the Electrum group of companies, along with various companies involved with them, Gatos, and Dularia, and Sunshine are in, as well as a lot of other companies. We're very happy to see them and to have them back. We also have a partner, Shanghai Huatong Silver Exchange, which is our partner in China. They translate and distribute these reports and have done so since 2014. And then we also have now 18 this year distributors and media partners. These are companies that help distribute the reports and make them available as broadly as possible. The history of CPM Group's Silver Yearbooks goes back to 1971 at least. You can see this one report that says annual review and outlook from J. Aaron in the silver cover. That was from 1971, and the research department at J. Aaron started late 60s, early 70s, and would produce these reports. They grew in size, and you can see the annual silver review and outlook from 1983 next to it. We left Goldman and J. Aaron in 1986 and set up as CPM Group as an independent research and consulting company. And we were producing precious metal, silver, gold, and platinum group metal surveys from 1986-87 onward. They became the yearbooks around 2005, 2006. You can see the 2016 Chinese version. And then over on the left, you can see the old Handy and Harmon reports. That was the other company that did primary research, coming up with estimates of how much metal is being not only mined, that data is relatively easy to come by, but the secondary recovery from scrap, the amount of inventories, fabrication demand, investment demand, government stocks. Most of that is secret, and Handy and Harmon and J. Aaron / Goldman Sachs / CPM Group are the two companies that have gone off and developed those data. After we left Goldman Sachs and it was clear that we were a surviving entity, Handy and Harmon stopped publishing its reports and actually handed over its files to us. Below it is the World Silver Survey from 1990. In the late 1980s, the price of silver was falling and investment demand was falling. And the Silver Institute came to CPM Group and initially hired us as advisors and said, why is the silver price falling? And we said, well, for a variety of reasons. One is that primarily investment demand is falling. But in addition to that, in the late 1980s, you had a number of companies getting out of the silver bullion sales business. And so you not only had fewer investors buying, but you had fewer sell-side financial institutions selling. And the only information that was really available was CPM Group's silver surveys, which were quarterly reports at the time and cost $2,200 a year, I believe, for subscription. So the Silver Institute then asked us for the right to strip down one of our quarterly surveys every year and make it into the World Silver Survey. We did that for 5 years and then decided that we didn't really want to be working with them. So we created our own, we had always had those silver surveys, and we continued to do that. And we started taking sponsors in, I believe, 1995, 1996. So that's the history of our reports. They go back a long way, and they today are the only independent reports that have, proprietarily generated estimates of not only mine production and reserves, but also secondary supply, fabrication demand in various countries, investment demand, inventories, and market conditions, not only in the physical market, but also in the futures market. There are other people who do that, but they tend to work in conjunction primarily with people who market silver. CPM Group is an independent, unbiased company. People pay us to get it right, not to be bullish or bearish. Turning to silver and what happened in 2021 and where we are in 2022. In 2021, the silver price averaged $25.17. That was up about 21.7% from $20.68 in 2020. And it was up even higher from around $15, $16 in 2019. And you can see from this price chart, the price of silver, yes, it rose very sharply into April through April of 2011, came down with a thud in May of 2011, but it stayed in that range of $32 to $44 an ounce through 2011 into the final quarter of 2011. Final quarter, it fell below $32 and it got down to around $27. 2012, it moved sideways. And then in 2013, it declined, and it spent a long period of time really between, say, $12, $13 an ounce and $16 an ounce, $18 an ounce, from basically late 2014 into the middle of 2020. The price started rising in the middle of 2019, came in and consolidated for a while, then it moved up sharply in the middle of 2020 during the pandemic and the economic lockdown and recession. Then it has been consolidating since that time, and it continues to consolidate in this range. Over the course of 2021, silver prices actually declined about 11%. They had ended 2020 at $26 an ounce, and they ended 2021 at $23.35. They reached the high of the year at $30.35 on February 1st. And that was this little spike up, lasted one day, came back down. And most of the time it spent in 2021, it spent really between, say, 28 and 21.50. It reached as low as 21.40 in September of last year. Our expectation is that we are going to see a continuation of that consolidation period for the rest of this year and possibly through 2023. I'll talk about our economic outlook in a second because our price projections are predicated on our micro analysis of the silver market by sector and our macroeconomic analysis of the world and how competing assets, specifically currencies, stock markets, bond markets, will be performing because that heavily affects investment demand, which is probably the primary factor driving silver prices higher or lower. Our expectation has been and continues to be that this consolidation period above 21.50 continues for the rest of this year. We got down to about 21.69 yesterday, I believe. So we, a lot of people were surprised that the price could get this low. We've been saying that we thought the base was around 21.50, and quite frankly, we expect some price weakness now for the rest of the second quarter into the third quarter. There are a lot of things that are out there that are scary and worrisome that could change that. But our expectation is still that the scariest and most worrisome things are probably lying beyond 2022 and maybe even beyond 2023. So our expectation is that this consolidation period between, say, $21.50 and $28 continues for an extended period of time. And then ultimately, we do think it changes as the price ends, as the economic and political world changes, probably 2024, 2026. I wanted to put up this longer term price just to show you where the price is. Silver prices at $25.17 last year was the third highest annual average price, topped only by 2011 and 2012. So it's funny because there are people who say, why are silver prices so low? And then there are a lot of other people who say, why are silver prices so high? And the proper question is the second one. Why are silver prices so high? And that's what we're going to be talking about today. Here's our economic view, and we really haven't changed it much. We had been talking about the potential of a recession in 2024, 2025. That's been our view for at least a year now. There are more people who are now talking about the potential of a recession in 2023. We look at various economic trends, including, say, capacity utilization, housing market trends, consumption trends, economic growth in various countries. And we think that a recession still probably holds off until 2024. But we acknowledge that there are increased volatilities and uncertainties in the world, Russia's invasion of the Ukraine being one of the key factors there, and the effects of rising interest rates. And it is possible that we would see a recession sooner rather than later. It's always difficult. If you go back to 1978, I was projecting a recession in 1979, and I was wrong. There was a recession in 1981, and then another one in 1980, and then another one in 1981, 82. In 2006, 2007, we were projecting a recession in 2009, and we were wrong. It was in 2008 into 2009, and actually starting toward the end of 2007. So it's kind of difficult. It's very difficult to project the onset, depth, and duration of recessions. Our expectation still is 24, 25, but that could be changed. That could change tomorrow, given the war in Ukraine. But that's where we are economically. Chart we shows inventories, and the green part at the top is coins, mostly bullion coins, mostly added since the mid 1980s when the U.S. Mint and the Canadian Mint created the Silver Eagle and the Silver Maple Leaf. And we're proud to say that we were advisors on both programs in creating both programs at that time. And what we've seen over the time, and you can see it here, the yellow part is the implied unreported inventories. And you can see that the green part, the coinage, has grown very sharply. And that stuff at the bottom, ETPs, exchange traded products, not all of them are exchange traded funds. Some of them are exchange traded notes and such. They have grown in importance too. So we've seen a shift in investor holdings away from 1,000-ounce bars and other smaller investor bars like 100-ounce bars and kilo bars and things like that. We've seen a shift away from that to coins and ETPs, and that shift is probably going to continue. The other thing is you can see how inventories basically peaked around 1990. They fell for about 15 years into around 2005. Since 2005, they've been rising again, and most of the increase has been in coins, in coin form. And part of the reason is that, you know, once the price of silver, when the price of silver was $350 to $550 from 1990 until 2005, a 1,000-ounce bar was $5,000. But once the price was $15 or $20 or $30, all of a sudden a 1,000-ounce bar was much more expensive. And there were also tax issues about trying to sell those things that you obviated if you were trying to sell silver coins instead. So there was a shift. There has been a shift away from 1,000-ounce bars, and that will probably continue. Now, before I hand it over to Rohit to talk about what we call the real silver market, I wanted to talk a little bit about some of the noise in the market, because one of the key characteristics in the silver market last year, unfortunately, has been the arrival of a lot of people who have grossly misrepresented the silver market in trying to promote silver to investors. And it's interesting because if you look at the flow of silver into investor holdings, there has been a little bit of increase due to them. But if you look at the timing and the nature of a lot of the investment demand that we saw last year, it hasn't necessarily been in response to that. And as the year progressed, especially in the second half of last year, you saw a number of investors pulling away from silver because the market was, they felt, overcrowded with misinformation and bad information and bad analysis. And they said, I'm a stock investor, a bond investor. I'm used to, markets that are regulated so that you can't really just go around saying stupid things about stocks. And bonds are primarily well, part of it is the corporate analysis, but also for corporate bonds, a lot of it's mathematics. So you saw a lot of investor distaste. So this has become a factor in the market, and therefore I think we have to address it. It started with the squeeze. Well, let's squeeze the market, let's drain Comex inventories, and we'll drive the price to $50 or $100 or the upper triple digits, as one of the guys was saying, or $1,500, as another guy was saying. But he's been saying $1,500 since 2007, 2008 or so. So we can sort of set him aside. The squeeze, we're going to drain all the stuff, silver from Comex, and we're going to drive the price to $50 or higher. And the price did get over $30 on an intraday basis one day on February 1st. And then it came back down. And then I was like, oh, well, we didn't mean that when we said we wanted to squeeze the price, squeeze the silver market, we didn't mean that we were trying to drive the price up, which is, I guess, the definition of a squeeze. But, because we don't know what we're talking about, we can use the word squeeze in a different fashion. So it's not that the squeeze failed. It's just that we were just trying to drain inventories. And unfortunately, inventories are at record levels. I showed you the numbers on a world total basis. We're at record amounts of silver. A lot of it's held in coin form and ETFs, but even in the Comex and in London, we had London inventories reported today for April. They're off about 2%, but they're still pretty much at record levels. They're at very high levels in Shanghai. And on the Comex, total eligible and registered and eligible inventories rose to a record level in 2020, early 2021. And while they are off about 50 million ounces in total, they are still at record levels. And if you look at that 50 million ounces, most of that was actually industrial and institutional investor demand coming out of the Comex. It didn't necessarily represent the efforts of folks trying to squeeze the market. But there was other nonsense and stuff, falling inventories at a time of record high inventories. The average grade of silver being mined was falling, and it was because the world was running out of mineable silver. No, the average grade of silver being mined was falling because the price of silver went from $5 to $50 to $20 to $25. And you mine a lower average grade when you do that. And we wound up explaining that in last year's Silver Yearbook. We explain it again in this year's Silver Yearbook. It wasn't that the world's running out of mineable silver. We have more reserves of mineable silver today than we've ever had in history. And we also have more silver in refined form above ground than we ever have had before. And then there's the stuff about draining the Comex. And as I said, it wasn't there. And there was this weird thing that they were doing that, investors couldn't even take delivery of a bar of silver off the Comex. And these guys were sitting around, saying, well, we keep trying to do this and it's not working. And it goes on for days, it goes on for months. The reality is that it takes 2 days to take delivery of silver out of Comex registered inventories. You deregister the inventories, they go into eligible but not registered, and then you take them out. And it happens every day. And it takes 2 days for settlement. On May 5th, last Thursday, 700,000 ounces were withdrawn from Comex inventory. That's a kind of a normal day. On Friday the 6th, 1.7 million ounces were withdrawn. So these guys, might have trouble getting a 1,000 ounce bar, but other people are taking 700 or 1,700,000 ounce bars out of the market on a daily basis. And other metal is coming in. So the inventories don't fall by that much because metal's coming in. And quite frankly, the deliveries over those 2 days were probably in excess of 2 million ounces a day, because the metal flows into those depositories and then it flows out of those depositories and it goes to people who make investment products and silverware and electronics and solar panels and all sorts of other stuff. So it's not there. And the key to look at it is the deliveries, which are very low. You can see, 50 million ounces here at the bottom versus 350 million ounces of inventories. And if you look at the deliveries as a percentage of inventories, you can see it's generally speaking lower than 10%. During the volatility of 2000, before the squeeze started, you did see a large spike in metal coming out of the Comex because people needed it and wanted it either for investment products or for industrial manufacturing, fabrication of silver-bearing products. But by 2021, it had come back down and it was basically below 10%, which it has been for much of the last 10, 12 years. Interestingly enough, you can see back in the 80s and 90s, even into the Audis, the deliveries were a higher percentage of inventories at any given time. But there's plenty of silver around. It's not necessarily going to go away. At this point, I'm going to go away myself. I'm going to turn my camera off. I'm going to hand the screen over to my colleague, Rohit Savant, who can take over. And then I'll come back at the end for the question and answer period. Thanks.
Thanks, Jeff. So I'm going to start here by talking about silver investment demand. Net silver investment demand stood at 96.8 million ounces in 2021, which was up about 50% from 2020 levels and was the highest that we've seen since 2016. Investment demand during 2021 rose because of negative real rates, increased concern about inflation, ongoing political tensions, and expectations of strong demand from the solar panel and electric vehicle industries. Now, while demand from the solar panel industry was strong during 2021, demand from the auto industry has been less than stellar due to reduction in auto production. Also, both these sources of demand have a strong future. However, demand will have to rise a lot more from these sources before they make a meaningful difference to the silver market balance. So basically what we're trying to say is that these are positive fundamentals for the silver market, but there's still a lot more demand that needs to come out of these markets or these sectors before they really start to influence the silver market balance. Net silver investment demand during 2022, we are forecasting that to stand at about 76.2 million ounces, which would be down about a fifth. And while that's a fairly strong decline when you compare it to where it's been historically, it's going to be higher than periods that we've seen between 2017 through 2020, as well as the period between 1988 and 2008. The biggest headwind to silver investment demand this year, we think, would be real rates. Our expectation is that real rates will remain very low due to strong inflation, at least over the next few quarters. However, they will be higher than they were during the past 2 years which we think will act as a headwind to both silver prices as well as silver investment demand this year. Silver investment demand during 2022, we also think will be supported by the metal's role as a portfolio diversifier. Russia's invasion of Ukraine was a good reminder about the need for portfolio diversifiers. And the expectation of strong demand from the green energy sector, we also think that's something that would continue to provide support to silver investment demand this year. It's worth noting that investors have been showing greater interest in silver since 2020. That said, there is hesitance on their part to buy in the same way that they did during the last run-up in prices. And part of the reason for this is that back then, there were these expectations that prices would rise to $50 or even $100, which haven't really materialized to date. And part of the reason for the hesitance is the sharp decline that we saw in silver prices back then, which have either resulted in investors locking in huge losses or still holding on to them. So there is a lot of reasons why investors should be buying silver, and we do think that there will be that demand, but there's also this concern about what has happened in the last run-up in silver prices, and I think Jeff explained this in a fair bit of detail. It's also worth mentioning that the gold to silver ratio that had declined during the first half of 2021 has now risen back to the upper end of its historical range, and in April it averaged around 80. And while the increase in the ratio does not guarantee higher silver prices, silver's relative underperformance to gold improves its appeal to some investors, and I think that would be another factor that would help to provide some support to silver investment demand during 2022. Global coin demand rose to 128.5 million ounces in 2021, which was the highest level of such demand since 2015. The relative softness in silver prices during 2021 compared to the second half of 2020 helped to boost demand from these investors who are typically long-term price-sensitive sort of investors. As an example, investor interest in these products, as can be seen in the chart on the left-hand side, there was a sharp increase in the volume of sales, US Mint coin sales. And this was despite historically high premia for these products, as you can see in the chart on the right-hand side. So ETF investors added 61.2 million ounces of silver to their holdings in 2021, which was the third consecutive year of net additions, and was slightly higher than the 57 million ounce annual average net additions over the past 2 decades. A part of the outsized 333 million ounces in net additions that we saw during 2020 was banks swapping large volumes of silver that was sold to them that year with silver ETF shares. And it appears now that over the course of 2021, a lot of those ETF shares have been sold back to into the market. So with that, we move on to silver fabrication demand. Silver fabrication demand rose during 2021, but did not fully recover losses that it endured during 2020. Silver fabrication demand stood at 890 million ounces in 2021, up from 872 million ounces in 2020, but still lower than the 927 million ounces that was recorded in 2019. Growth was seen across most sectors except photography, which has been in a declining trend for almost 2 decades now, and the ethylene oxide industry. Jewelry demand ticked higher last year, primarily because of restocking demand from jewelers, softness in the US dollar, excess savings, and pent-up demand from 2020, and broadly improving economic conditions. The primary headwinds to jewelry demand last year came from relatively high silver prices and weakness in demand from India, where COVID kept much of the country in lockdown during the first half of 2021. Now, while demand did increase sharply in India during the second half of the year, it was not strong enough to completely offset the losses that occurred during the first half of 2021. During 2022, jewelry demand is forecast to continue rising, but at a slower pace than we saw in 2021. And that's because of much of that restocking demand that we saw in 2021 is now behind us. The US dollar is getting stronger. Silver prices are still fairly elevated. And high inflation should be expected to reduce consumer expenditure on discretionary items like jewelry. So we think this is something that would weigh on jewelry demand during 2022. Demand from the electronics sector stood at 229.6 million ounces in 2021, which was up about 2.3% from 2020 levels. The gains would have been stronger had it not been for the disruption to production at various semiconductor manufacturing facilities. There also was a reduced rush last year in 2021 compared to 2020 in purchasing things like laptops and other equipment needed for work at home or school from home that was pretty rampant in 2020 when there were lockdowns pretty much across the globe. Silver demand from the electronic sector is forecast to reach a record high 234.6 million ounces this year. Silver demand from this sector is strong because of the increased use of electronic and electrical applications in pretty much every consumer purchase now. That said, we do think that the ongoing shortage of semiconductors is expected to result in sub-potential growth in silver demand from this sector this year as well. Silver demand from the auto sector has been one of the biggest victims of the semiconductor shortage. The decline in auto production over the past couple of years, first because of the pandemic and then because of the semiconductor shortage, has been weighing on silver demand from this sector. And while hybrid and EV use more silver than what typical internal combustion engine vehicles use, the increase in demand from these electric vehicles has not been strong enough to completely offset the weakness in auto production over the past couple of years. And as a result of this, silver demand from the auto sector still has not surpassed levels that we've seen in 2018. The strongest growth in silver demand last year was observed in the solar panel industry. Demand here rose to a record 104 million ounces, and that increase in demand was driven primarily by a sharp increase in panel production. Any loss in demand due to thrifting, which has been an ongoing issue with silver use in solar panels, was more than offset by the increased panel production. Panel prices also rose last year, primarily because of an increase in raw material prices as well as a pullback in electricity usage in China, all of which kind of pushed up prices of solar panels. But despite that increase, you continued to see a sharp increase in demand for these panels. And panel demand, we think, is forecast to remain strong in 2022 as well, helping to drive silver demand from this sector to another record high. We're forecasting silver demand from the solar industry to stand at 114 million ounces this year. So after rising strongly in recent years, silver demand from the ethylene oxide industry slowed in 2021, and this is expected to continue in 2022 as well. That said, 2021 demand at over 25 million ounces and 2022 forecast demand, which is slightly lower than that, are both very high when you look at demand from this sector on a historic basis. On the supply side, both mine supply as well as scrap supply rose during 2021, reaching 987 million ounces, which was the highest since 2018. While mine supply did not fully recover its 2020 losses, during 2021, scrap supply was at its highest level since 2013. Mine supply has been in a declining trend since 2017, and there are a couple of reasons for this. The first is lost output at some major mines during this period, and a lack of new mine capacity, new silver mine capacity coming on stream to offset that lost output from some of those big mines. On the other hand, strength in scrap supply has helped to a large extent to offset the weakness in mine supply. Scrap supply in 2021 rose as a result of relatively high silver prices and the lifting of COVID restrictions in many parts of the world, which allowed for a smoother flow of scrap materials. Total silver supply during 2022 is forecast to be at roughly the same level that we saw in 2021. So new silver mine capacity coming on stream in 2021 stood at about 7.5 million ounces, which was down from 12 million ounces in 2020. New mine capacity has been in a declining trend since 2013, as can be seen in this chart. The rise in silver prices since 2020 has been attracting some investment towards this sector. But that said, mining companies have become a lot more disciplined and investors have become a lot more cautious following the massive spending that occurred in the metal sector during the last bull market. So it should be noted that, even though prices have risen pretty strongly in the past couple of years, they're still lower than levels seen in 2011 and 2013. So that's something to also keep in mind when thinking about prices and the introduction of new mine capacity. There also are other constraints to new mine capacity. One is resource nationalism and also increased environmental and other regulatory costs. So all of these factors we think are collectively weighing on new mine capacity for silver. Production weighted silver cash costs stood at about $8.27 per ounce in 2021, which was up from $6.48 per ounce in 2020. There were various factors that came together to push costs higher, which included the stronger silver price, a relatively weaker US dollar compared to what we saw in 2020, an uptick in energy prices, and an overall increase in inflation levels. There were a couple of factors that also helped control the costs during 2021. One was the increase in the amount of silver being produced during the year, which helped to spread costs over a larger number of ounces. And you also had higher byproduct credits because of the sharp increase in metals prices overall over the course of last year. So while average costs rose, the average price of silver also was higher during 2021, which helped to push the margin between these two metrics up to about $17 an ounce during 2021, which was the highest level that it's been at since 2012. So with that, I'll turn this back to Jeff for some concluding remarks. Jeff, I think you're still muted.
Sorry about that. So you should see me and you should see a page that says buy this book. I failed to mention at the outset, there is a question and answer period. You can ask questions through the chat room. There are a couple of people who already asked questions already, but we're open for questions now. Yes, The book is about 230 pages long. It covers a lot of the topics that we've covered here in much greater detail. It explains a lot of the issues that, people have had questions about, like what's the role of Comex, and are futures immoral, and why are banks involved in the precious metals markets. A lot of that stuff is in there, and it's discussed in an unbiased, honest sort of way. And you can buy the book, go to our website, download it. The last page of the book, it comes as an ebook. The last page says, if you want to print this book, you take the PDF to a quick copy shop, and here are the specs to have it printed and trimmed and perfect bound the way we used to do it ourselves, and then ship them. We have a retail investment program, and you can go to our website and read all kinds of free reads that we have there and read about who we are. I'll open it up for questions right now. I think Carlos is going to sort of run air traffic control on the question and answer period. Carlos, any questions?
Okay, we have a few questions, Jeff. First one, is silver's inability to break its record price a sign that it is losing its monetary premium in favor of gold?
Well, first off, I think it's a financial premium as opposed to monetary premium. Silver really gave up most of its monetary status in the 1960s and 70s as governments got out of using silver in circulating coining. But there's clearly a financial status there. And I don't think that it's actually given up that status. I think gold has always had a more prominent position in the eyes of investors in more parts of the world than silver. It's not to belittle silver's role in investment demand, and it's not to say that a lot of investors in most parts of the world like silver and see it as an integral part of a diversified portfolio and a way to store and diversify wealth. Silver, I think, has always sort of been second gear to gold in that respect, and it continues to be. The fact that the silver price has not gone back over $50, I think reflects the reality of the silver market. There is, as I said, enormous amounts of silver that can be mined and has been mined and is sitting in above ground inventories. So one of the interesting things is, yes, you've seen very strong investment demand for silver, and those numbers that we give on investment demand, that's the net. So if you look at the silver market in any given year, we report the net investment demand, but there's gross demand and there's gross sales. So for example, if you go back to 1997, when Berkshire Hathaway bought 129.7 million ounces of silver, we had net sales of, I believe, several hundred million ounces in that figure. And that meant that while Berkshire Hathaway was buying more silver than anybody else had ever bought before in a given year, there were even more investors who were saying, hey, this stuff costs $4.50 an ounce. I've been sitting on it since I bought it at $8 an ounce in the mid-1980s. I'm getting rid of it. So you had large net sales in that year. I think silver has always suffered from the fact that it is not as universally accepted as a quasi money as is gold. In addition to that, as I said at the outset, we have noticed a palpable reluctance on the part of mainstream investors to touch silver because it's overrun with conspiracy theories and all kinds of nonsense. And these people, a lot of investors are turned off. They make jokes about it. They make jokes about silver investors. They make jokes about silver conspiracy theorists. As I said, when we were approached by the Silver Institute in the 1980s, they said, why aren't investors buying silver? And we said, well, first off, no one's selling it to them, marketing it to them. And the second thing is that the market is so opaque and so uncertain, no one really knows what it is. And then you actually had at that time a guy who started saying that there was some conspiracy to manipulate the silver price. And investors said, I just don't need to deal with that kind of stuff except at a comedy club. Other questions?
Okay, next question. Can you explain what role the bullion banks play in the physical silver market, or more broadly, why are they in the silver market at all?
Bullion banks are in the silver market because people want financial intermediaries. You know, a mining company selling its silver, generally speaking, will deliver semi-refined metal to either a refinery in doré form, semi-refined, or to a smelter in concentrates. And the mining company wants it to be paid as soon as possible. So typically what you'll see is as the metal leaves the mine site and is no longer in the control of the mining company, that mining company will sell that metal. They'll sell it forward and they'll get maybe 80% of the value of it with the final settlement on outturn, so you know exactly how much metal's there. On the other side, you have fabricators who want to reduce their capital costs, free up capital for other expenditures, and don't want to have a lot of their capital tied up in working inventories for silver, gold, or other metals. So they will go to financial institutions. We call them banks to be clear, but the reality is that there are non-bank financial institutions that are involved in this as trading companies. The fabricators will go to a bank and say, I need working inventories. Will you lease me silver? And I'll pay you, instead of paying the normal fee for a lot of these guys, is interest rates on dollars or other currencies might be 10, 12, 18%, because a lot of them are private companies and they pay exorbitant interest rates. But I can borrow silver for 3% or 4% or 5%. I lower my financial transaction costs. I have a perfect hedge because I'm not buying that silver until I'm selling the silver bearing product, and it frees up capital for me. So you'll find sometimes, well, I haven't had it happen in decades, but it used to be that like jewelry companies would come, hey, why don't I buy directly from mining companies? Fine. What you need to do is buy semi-refined metal at the mine site, at the gate to the mine, and then you own it during the smelting and refining and semi-fabrication process until you have it. Jeweler says, no, I want to buy it from them, where they deliver me refined metal at my factory and I lease it from them until I sell my product. Well, that's not what mining companies do. That's what banks do. And then on the flip side, you'd have mining companies coming, why don't I sell directly to fabricators? It's like, okay, fine, here's what you do. You own that metal throughout the refining process, and then you deliver refined metal in the form they want, because most jewelers and electronics companies and solar panel manufacturers don't want a silver bar. They want a silver powder or a silver chemical or some other silver wire or sheets or grains. So you can own that silver. And mining companies, no, I need to be paid as soon as the stuff leaves my mine site. Well, that's what banks and brokerage houses do. Yeah. So the reality is that these financial institutions are very critical to the mining side, to the secondary recovery side, to the fabricators, and to the investment product side, because a lot of people who sell investment products to investors also lease that metal in or hedge that metal. And they need financial intermediaries and financial counterparts to provide those financial services. Without them, there's no market. So for people to say, why would these banks even be involved in it? They're involved in it because they're banks. And that's what banks do. Now, a lot of banks no longer are involved in commodities markets because for a variety of reasons. And across the banking industry, you've seen this massive concentration of business. So you now have about 4 or 5 or 6 banks that are major participants in the commodities markets. You have 3 or 4 banks that do almost all of the mortgages. You have a handful of banks that provide financing to the oil and gas industry. The banking industry has become extremely specialized, and as a result of that, the amount of activity that a single bank does has exploded. I mean, I can go back 15, 20 years ago when 2 of the banks that were still involved in precious metals markets in the United States, one of them wanted to buy the other, and the other one wanted to sell itself to the other. And the Fed basically said, look, if you guys merge, we're down to two companies, two banks, two financial institutions providing metal on lease to manufacturers, smelters, refineries, and others in the United States. So you have to find a buyer for that, the bank being acquired. You have to find a buyer for their precious metals business before the Fed will allow this merger to go through. So regulators, despite what the conspiracy theorists say, regulators are actually on top of these markets, and they take steps like that 20 years ago to make sure that the liquidity is sufficient, both in terms of depth and breadth. Without those banks, you don't have a silver market. And to say, why are these banks even involved in it, is to say, I slept through money and banking 101, to put it nicely. Next question.
Okay, if the semiconductor supply chain issues normalize, will this release pent-up demand for silver in the auto sector? And what effect might that have on the price?
Rohit, you want to take that one?
Yeah, sure. So yes, if the supply chain normalizes, you will see an increase in demand from that sector. Right now, the auto sector accounts for about 4.5 to 5% of total silver fabrication demand. Pent-up demand, increase in production, all of this would, we definitely do expect that this would push demand for silver up. What impact can it have on price? It should be something that is supportive of prices, but not something that we expect will drive prices up sharply, primarily because it's still a relatively small portion of the total silver market. So it's a growth area. And like I mentioned in the early part of my presentation, demand from both solar as well as the auto sector would need to grow a lot more to start having a meaningful influence on the price of the metal.
Okay.
Okay, next question. Is it true that the trading volumes on the Comex represent many multiples of the actual physical silver market and physical silver produced? And why is that so?
Yeah, there is much more silver traded on the Comex and other markets around the world than is individual mine production or ultimate fabrication demand. Now, we've explained this in our books for years, and we continue to explain it. One of the things is that if you look at the flow of physical metal from a mine to either an investor or a silver-bearing product, it goes through maybe 10 hands. It goes from the miner to the smelter to the refiner to the converter to the chemical manufacturer to the sheet manufacturer to the plater to the stamper to the semiconductor manufacturer to the carrier to the computer or electronics manufacturer to the wholesalers to the retailers to the customers. Now, in some cases, those are the same companies, but you have this multiple of metal going through the market. So you might say there's 1 billion ounces of silver being mined and 800 or 900 million ounces of silver being used in fabricated products. But first off, there's a multiplier in that a lot of those fabricators generate 50% or even 80% scrap. So there's a working inventory that's needed for one thing. All of this stuff is hedged. So you get that in there. So the first thing you do is you say, okay, there's 1 billion ounces here of new supply / fabrication demand. And maybe the multiplier is 10, so it's 10 billion ounces. But that's still only about 10% of the trades. And that goes back to the first question, which is the financial role of silver in the market, or we call it monetary role. there's a tremendous amount of silver that is owned. I showed you the table at the outset about inventories. There's a tremendous amount of silver that is held by investors and others, and there is also a tremendous amount of trading. Silver futures exchanges, which have been around since about the 15th century, I think, in Japan, and shortly after that in Europe. Exchanges exist for two reasons. The primary reason they were created was so that merchants, what we call banks, people who buy from producers and sell to consumers, merchants wanted to hedge their price exposure. And they do that by laying it off. I'm buying from you at a mine, and I may not sell it for months. Back then, they used the ships at sea. I may not sell that metal for a long period of time. In the meantime, the price is going to fluctuate, and it could fluctuate sharply. And I need protection from that price. So I'd like to hedge my physical purchase with a futures or forward contract. Problem is, who's going to take that risk? And the person who's going to take that risk is an investor. So back in the 15th century, merchants had a tough job. Actually, it wasn't that tough. They would go into the town square and they'd say, we're going to finance a ship to India to pick up a lot of spices and goods and silks and other things that the Indians have that we want, or China or the Philippines. And there's a certain risk here. We need to raise the money to rent that ship and pay the sailors and have money on the ship to take there to buy this stuff and bring it back. And there's untold riches that can be had once we have the stuff back in Europe. So if you want a piece of it, I'll sell you a futures or forward. It was a contract. And that's why it's there. Futures markets exist, so that merchants, banks, trading companies can hedge, and they attract investors who want not the commodity, they want price exposure to the commodity. Most of the people who are investors on the Comex are not interested in owning physical wheat or oil or copper or silver or gold. They want to own exposure to the price changes, preferably exposure to rising prices and not falling prices. So they might use options nowadays rather than futures or forwards. But they exist there because they want to make, they want price exposure. And that's why the exchanges exist. And there's a lot more of those people with a lot more money than there are people saying, well, yeah, but I need silver to make electronics or solar panels or mirrors or brazing alloys. So that's why you see a much larger trading volume, futures, forwards, options, and physical metal than you see actual supply and demand. A long explanation, it's where it is. Going back to one of the earlier questions, part of the question was, well, there are these people who look at the large short positions that banks and trading companies have on the Comex, and they're only looking at half the picture. They don't realize that those short positions represent two things. First and foremost, they represent hedges of long physical positions. I used to have a habit of having lunch on the first business day of the year with the fellow who ran the foreign exchange and precious metals desk at what was then one of the world's largest precious metals trading banks. And one year I said to him, something about, these guys waiting for the price of silver to shoot sharply higher. He said, I'll be the first to know, because not only do I have the largest silver short position on the Comex, I have the largest physical long position. And when this comes about, this was back in the 90s when the price of silver was trading between $3.50 and $5.50 an ounce. When this comes about, I will see it coming long before any of these people who are observers or investors or self-appointed experts on silver. So I'll see it coming because I've got the largest silver position physically, and I report it in my quarterly statements, unlike other banks. And everybody ought to know that I have that long physical position because I report it on a quarterly basis. And they ought to know that my short position on the Comex is nothing more than a hedge of my long position in the physical market. So a lot of people who look at these massive shorts don't understand what they're looking at. The other thing is that if you're an investor and you want to go short futures, or long futures, somebody has to sell that futures contract to you. There has to be somebody willing to take that short position. Now, there are some investors who are willing to short silver, but for the most part, you need a market maker. And the market makers, I hate to say it, are banks and brokerage houses. People who are market makers who stand there on the futures market and say, if you want to go long silver, I will go short silver and sell you that contract. It's different than it is for equities, which some people learned the hard way in 2021. But the reality is that those short positions that get reported in the commitment of traders represent short hedges of long physical positions, and they represent the fact that market makers are willing to go short in the silver futures contract in order that investors can go long. Questions,
Okay.
Carlos?
There are no more questions at the moment.
All right. Well, we've gone a little over an hour, so perhaps it's time that we just wrap this up. Again, I'll go back to the single most important slide that we have. Buy the book, 230 pages, and you can learn a tremendous amount. In late June, we'll be coming out with our Platinum Group Metals Yearbook. In between here and there, we have an open forum for our clients at the end of May. And then we have another silver seminar that we'll be doing in advance of the Prospectors and Developers Association of Canada annual convention. I believe that we've scheduled that silver seminar on June 1st. If you're participating in this today, you'll probably get an invitation to join us again then. And hopefully there'll be even more interesting questions then. In the meantime, take care of yourself, take care of others, be careful. Don't spend any vacation time in Russia. Bye.